All right, everybody. I'm Logan Alec. I'm a CPA, and today I want to talk to you about bonds. Now, bonds are actually kind of a controversial topic in personal finance. I've seen a lot of different strategies in terms of investing in bonds versus stocks or even other assets. So I thought it would be helpful to cover my perspective on bonds, what I think the main benefits and drawbacks are, and why I personally don't invest in bonds. As with anything else in personal finance, this video isn't necessarily to tell you that you should never invest in bonds or something like that. There really aren't that many strategies that I would completely recommend or not recommend to everybody because we all have different financial goals and we're all in different financial situations. We're at different ages, right? Personal finance is inherently personal, but at the same time, I think a lot of people buy bonds who probably shouldn't be buying bonds simply because they've been told that bonds are the safe option. For example, there's a kind of received wisdom that you should own your age in bonds. So if you're 30, then you would want 30% in bonds. If you're 50, you would want 50% in bonds, etc. And on one level, that makes sense since you'll want to shoot for safer returns as you get closer to retirement, and you'll eventually get to the point where short-term fluctuations are going to have a greater impact on the value of your portfolio when you're actually withdrawing it. Now, this might be good advice for some people. Again, I'm not here to say that you're wrong or anything like that. But personally, I don't own any bonds. And I know a lot of people who are starting to move to that kind of approach as well. So in this video, I'm going to cover a couple reasons why I don't personally invest in bonds. First reason is that bonds simply don't offer the same opportunity for growth as stocks do over long periods of time, not to mention leveraged real estate. So as I said, one of the main reasons that people typically recommend investing in bonds is that they're perceived to be a safe investment. So unlike stocks, which can vary pretty dramatically depending on the market conditions at any particular time, the theory goes that you're usually going to avoid the big losses, at least in the short run, if you put your money in bonds rather than stocks. And that's mostly true. Just check out this year-to-date chart for the Vanguard Total Bond Market Index Fund. You'll see that at the beginning of the COVID-19 crisis, the value for this bond index fund peaked on Friday, March 6th at $11.63, and it bottomed on Thursday, March 19th at $10.87. That's a decline of about 6.5%. Now, check out this year-to-date chart for the Vanguard Total Stock Market Index Fund. You'll see that the pre-crisis peak was on Wednesday, February 19th at $83.79, and the crisis low was on Monday, March 23rd at $54.49. So the stock market index fund dipped from its pre-crisis peak, its pre-crisis 2020 peak anyway, by 29.3%. So obviously that crash of 29.3% for the stock index fund sounds a lot worse than the 6.5% crash for the bond index fund. In fact, if you go all the way back to the year 2000, so that's 2 full decades, the worst year that the Vanguard Bond Index Fund ever had was in 2013 when it dropped by just 2.26%. 2018 is the only other year since then where it lost value at all, and that was only about 1/10 of a percentage point. So that's a big drop for bonds. You don't have to worry, or you don't have to worry as much about a big drop even during the bad times. But as I said before, that bond fund only lost value in 2 out of 20 years going back to the year 2000, but it also hasn't gained more than 10% in a single year since it went up by 11.39% in 2000. On the other hand, the S&P 500 has had some really bad years. It went down by almost 40% in 2008 alone, but it also isn't uncommon to have years of 10, 20, even 25 or 30% growth. So, example time. Let's say you lost a lot of money in 2008. You were scared, you swore off stocks, you said, I'm never investing in stocks again, they're too risky. And you decide to put your portfolio in bonds to avoid taking that kind of hit in the future. And if you're primarily investing to avoid losses, you would have done well over that time. In fact, from 2009 to now, you've gained an average of a little under 4% per year, which is a lot more than you would get from a savings account or something like that. But on the other hand, if you had kept your portfolio in stocks, say 100% in the S&P 500, just to keep things simple, even though there were a couple bad years in there, you still would have generated more than 13.6% per year. So over 3 times the returns, and that's just per year. And when you consider the impact of compound growth, it actually turns out to be way more then 3 times more valuable. Now, an index fund doesn't compound in the same way that a savings account or a certificate of a deposit does, but even if you just compound the gains from year to year, let's say you start out with an investment of $100,000 in bonds at the beginning of 2009, that would have grown to about $150,000 in 2020. So your money would have increased by about 50%. I think you know where I'm going with this. But the same amount of money invested in the S&P 500 at the beginning of 2009 would be worth $388,000 in 2020, which works out to a return on investment of almost 400%. And keep in mind that neither of these two calculations factor in reinvested earnings. Of course, this reflects some particularly good years, but even if you include the losses from 2008, which again were close to 40%, you still would come out way ahead in stocks over bonds. Well, obviously in the short term, 2008, in the short run, your losses were minimized more with bonds than stocks, but in the long run, stocks gave you a much greater return. So overall, my point here is that yes, stocks come with more risk in any given quarter, in any particular year, and you might even getting disappointing returns over a few years, but historical performance shows that bonds are unlikely to perform stock market index funds over any significant length of time, which is really what you need to be thinking about if you're saving for retirement or another long-term goal. So personally, I might start to put some money in bonds when I'm about to retire in a few years, right? Obviously, I don't want to have to sell my stocks low when I need money, but I'm in my 30s right now. If you're in your 20s, 30s, even 40s, then honestly, I don't see much of a reason to invest in bonds at all. Again, that's just my opinion, my personal philosophy. I think there are a lot of people, however, who thought bonds were the safe investment after 2008, but what they didn't realize is that safety means something different over a period of 3 months, or 1 year, or 2 years, or 3 years, compared to a period of 10, or 20, or 30 years. So to me, it makes more sense to take the ups and the downs that come with stocks, not worry about where the stock market is right now, because I'm not going to be retiring for another few decades. Ultimately, the smart bet for me is to keep buying as much as I can, regardless of market conditions. And over a sufficiently long period of time, I'm probably going to get the results that I've been looking for, which is more than I can say for bonds in most situations. When I get more money, right, I put it into stocks, okay, unless, I'm about to buy a piece of property. All right, another reason I usually see people advocate for investing in bonds is that if you invest in the stock market, there's a chance that you'll need the money right when it's at its lowest value. So for example, if you had all your savings in stocks and you lost your job at the beginning of the pandemic, and let's say your state was screwing you over with unemployment, they weren't processing your claim, you needed food, right? It was just a bad time. Then you would probably be in a situation where you had to sell stocks, right? And likely at a big loss, or at least a significantly reduced gain in order to feed yourself, right? You would have to cash out the worst possible time, okay? Because remember, you don't actually lose money in stocks until you sell, right? But once you sell, you've realized that loss, you've captured that loss, and capturing that loss in a down market, that's not ideal. So there is an intuitive appeal to bonds in this situation, right? And it's true that bonds are probably going to help you prevent those specific situations from popping up. But at the same time, I'm not sure that this argument alone makes it worthwhile to pursue this strategy just to hedge your bets against a recession or a downtime or something like that. And again, this comes down to the numbers. I'm sure there were a lot of people who were happy to have bonds when the market crashed in March, but that crash only represents a tiny snapshot of stock versus bond performance over years and years and years. Yes, if you invested in the S&P 500 right before it fell, right, then you would have lost a lot of money, at least on paper. But even in that situation, you would have gained it all back over the last 6 months, assuming you didn't get spooked and sell all your stocks, assuming you held on and stayed the course. So for me, the problem with the logic of this argument in favor of bonds is that people will invest in bonds to avoid market downturns, but they might not realize that they're also avoiding all the gains they would have made by investing in stocks on the upswing. So if you had stocks for the last 10 years and your friend had bonds, sure, you lost more money in March specifically on paper, but even after that loss, you would have still done way better over the entire period of time, and the S&P 500 has actually done better than that bond fund we looked at, even when you just look at 2020. Now, if you're not familiar with timing the market, basically it's a strategy where people try to buy or sell investments at particular times because I think the value of that investment is going to trend in a particular way, right? So if you knew exactly how the market was going to go every day, you would always know when to buy and when to sell, which means you would get all the gains and none of the losses. And a lot of people try to do this in their own investing. For example, if you were worried about COVID-19, maybe you pulled your money out before the crash, right? And that might have worked if you were lucky enough, right, to sell at the exact right time. But the reality is that the market is far too complex for anyone to make reliable predictions like that over and over and over again over the long run, right? Over time, trying to time the market is only going to backfire, right? Because you'll miss out on some gains, right? And plus, by keeping on buying and selling and buying and selling, you're going to pay taxes on your gains, which creates a drag on your true gain, your after-tax gains. So this all comes out pretty clearly in a well-known example from a Redditor named Jerschneid from the Financial Independence subreddit. And basically, what Jerschneid did was he took a look at 3 hypothetical investors who saved $200 per month for 40 years. So going from 1979 to 2019. I'll put a link to the post in the description below in case any of you want to check it out. But essentially, the first investor saved their money and only invested it at the top of the market. So worst time to invest, okay? The second investor only invested at the bottom of the market. So good time to invest. The third one put $200 in every month, regardless of how the market happened to be doing at each particular time. And what Jerschneid found is that even if you're somehow lucky enough to only buy at the bottom of each crash every single time, you still end up worse off than you would have been by investing consistently and paying no attention to the market, precisely because you will have missed out on so many gain periods. So the person who invested at the worst times in this example finished with $663,000. The next person, the one who saved their money and only invested at market bottoms, finished with $956,000. And the last person, the one who consistently invested $200 every month, regardless of how the market was doing, this individual finished with the most money at $1,386,000. Now, obviously, this is more about timing the market than it is specifically or directly about the stocks versus bonds argument. But what it tells me personally is that investing in bonds, so you don't lose money during a crash, is going to hurt you more often than it helps you in the long run. So if you kept your entire portfolio in stocks, right, and you need cash because you don't have an emergency fund, yes, there might be times when you have to sell for a loss or at least at a significantly reduced gain in your stock portfolio. But again, assuming there are times in your life when you have to cash out of your stocks, right, assuming this fact pattern, then there are going to be more times when you sell for a gain, right? And you shouldn't miss out on those gains just because you're worried about the losses, because ultimately the loss you might get from a particular crash is almost nothing compared to the loss you would get from investing in bonds for years and years and years and missing out on all the stock market gains that come in between those crashes. All right, everybody, that is what I have for you today. Obviously, you could get a lot of advice from different people on the topic of stocks versus bonds, but these are a couple of the main reasons why I personally avoid bonds and put my entire portfolio in stocks, excluding real estate, of course. Now, I said this earlier, but again, I want to emphasize I'm not telling you to never invest in bonds for any reason. Obviously, I'm in my 30s. My perspective on this is a lot different than somebody twice my age. I just want to give an alternative perspective because people often talk about bonds as a kind of common sense choice without really questioning it. Of course, if you want to keep a little bit in bonds as an emergency fund or something like that, then, that might make sense. People usually recommend putting emergency funds in, high yield savings account. But as we've seen, bonds have had pretty strong historical performance and certainly a better average than what you'd get from a high yield savings account, at least right now with all the major providers, typically under 1% right now. But if you follow the, own your age in bonds rule, then you could easily end up with tens or even hundreds of thousands of dollars just sitting there, not gaining as much value as they could just because you want to avoid risk. But if you have all your other financial ducks in a row, right, and you have a well-crafted, well-thought-out portfolio, you probably shouldn't have to worry about that as much as some people might say. So hopefully this video gave you a better idea of the pros and cons of bonds versus stocks and why I am in favor personally of 100% stock allocation given my age and risk tolerance and other things, okay? But of course, this is just my opinion. I hope it's helpful for you, and I want to thank you, as always, for watching to the end of the video, and I will see you next time. Bye-bye.